So the big regulatory story from Sebi, a comprehensive overhaul of the mutual fund regulations 1996. The focus is on simplification, cost rationalization and great investor protection. Now to decode what this really means for you and for the mutual fund industry, we are joined by Feroze Azeez, one of the India's leading voices in markets and investments. Feroze, good evening. Welcome to the show. So let's just begin with the very important question, expense ratio overhaul. Feroze, this is the heart of this proposal, okay? The expense ratio changes. Now, Sebi wants to exclude statutory levies like GST, STT and stamp duty from the total expense ratio. How significant is this move and how much difference will it make to investors' return in real terms?
Kavita, one is, like you said, there's fee, there is cost rationalization, there is investor protection, there is all of this in that circular or consultation paper, not a circular. Now, coming to the first point, like you said, expense ratio grabs a lot of limelight, but the impact is marginal. Okay, both for the investor and the asset management company. But for the investor in the long run, uh, even if you're a shareholder of an asset management company, it's good news to my mind. Why? Because in the long run, any kind of transparency is going to develop the mutual fund industry. What they're saying is so right. SEBI has caught the biggest problem I as a distributor also have. If I go to an AMC and try and find out what is the total expense ratio, what is the distributable expense ratio, which we call distributable TER, DTER, the difference is so difficult to decipher. There is GST, so bringing in clarity and excluding fees and costs separately in the long run will have immense amount of transparency. And when you separate two things, management becomes so much more and efficiency will become so much more. For example, if brokerage is outside, then it is visible to naked eye. One AMC will compete with another AMC. One broker would give it cheaper. And there is brokerage is also being capped. And that is also, to my mind, logical. Of course, not too many people who like me to say that. Because if a individual client is getting brokerage almost free in India, why is somebody with 2 lakh crores paying brokerage? The answer we get is research. Brokers, institutional brokers provide research. So pay them separately from your profitability or your expenses. So from your share of expense, so I think transparency, efficiency, management of the costs and expenses separate, I think is a master stroke.
Right. So let's take it one by one. I also want to understand now the removal of 5 bips charge. Now, fund houses may no longer be allowed to charge that additional 5 basis point on schemes with exit loads. Now, how do you see this? Do you see this as SEBI's way of curbing layering of cost, which you were also talking about? Is it more symbolic in nature? How would you like to explain this?
See, Kavita, if I have to explain this, I have to go back in time and say, when did it start? What was the rationale of it starting? What used to happen before this 5 paisa was levied is any exit of an investor, if there was an exit load, who used to keep the exit load? Not the scheme, but the asset management company. So, if one were to redeem, the exit load is not credited back into the scheme. So AMC said, SEBI said this doesn't seem logical. How can an exit of a client benefit an asset management company? So when they removed that, they said, why don't you charge a 5 bips to the scheme and credit all the exit loads into the scheme and charge them 5 bips. Now that's a large change, this was a painkiller given at that point in time when the industry was maybe 1/5 or 1/7 this size. Now the painkiller has been administered to the asset management company. Now they're saying, okay, let's move on now and get this out because this is still not logical. So I think I appreciate that, and I don't think AMCs will be too perturbed with that, to my mind. And I see that as a great correction of a painkiller which was being administered to the asset management company. All these changes, net, will make sure that this industry from 75 lakh crores goes to 300 lakh crores. And to go to 300 lakh crores, an AMC with 44 companies need to do some pain in the short term. You don't get great pleasure in short term and pleasure in long term. That's academic. You have to take pain in the short term to build a business for the long term. And that's what I think SEBI is pushing the industry to. And I'm sure there'll be some tweaks in the final, whatever transpires, but the consultation paper is in the direction, which I think is beautiful.
Right, right. The consultation paper also talks about the brokerage cap reduction. Now, brokerages caps have been sharply cut, Feroze, from 12 bips to 2 bips for equities and 5 bips to 1 bips for derivatives. Now, what's the likely impact on fund managers' execution ability, especially for active equity funds? Could it limit the flexibility, or is it about cleaning up inefficiencies or a painkiller that you just mentioned about?
Yes, I love the citing they've done in the consultation paper. How microscopic is Sebi?
Yeah, yeah.
Okay, I can't be more happy that equity markets, especially mutual fund, and large portion of the equity market is governed by Sebi. Okay, so when you look at this, I yesterday had to go with a client to withdraw his own money after 11 years to insurance offices to get your own money. And there you have IRDA, who also has to look at investor protection. The insurance company made us wait for an hour each so that we don't withdraw the money. Here we have SEBI looking at what they have looked at in that consultation paper is saying for arbitrage fund you're paying 2 bips. Why is the same asset management company paying 12 bips? Of course, arbitrage is a riskless, there is no research needed. But this kind of disparity between one scheme and another, buying equity in one scheme, which is arbitrage, is different, 6 times more cost on the equity side. If a regulator is ready to go so microscopic, it gives me a great degree of satisfaction that a distributor or an asset management company operating under such regulatory environment will help create a tailwind for the industry, which will be very good in the long run.
One more very interesting thing, and Feroze, we've discussed about this a lot of times, on the show and even off cam, differential expense ratio, which is performance linked fees. Very interesting new idea allowing differential expense ratio based on fund performance on a voluntary basis. Now, do you see this as a beginning of performance linked pricing in Indian mutual funds, and will it actually align fund houses' incentives better with investor outcomes?
Kavita, I can't agree more that when you align incentives to client outcomes, it's a very, very good thing. One. Second, if the private equity industry does that, right? And you look at a private equity fund manager in the US, there are about 20,000 private equity companies, right? Most of them are worried to get the carry. So it's good to align. But the problem in aligning, I don't know how the implementation is possible on a pooled account. See, today in PMSs, portfolio management services, where Feroze has a separate account, Kavita has a separate account, everybody has a separate carved out account. Charging a profit share to Feroze is very easy depending on Feroze's outcome. But in a pool account where there are crores of investors, somebody enters on a specific day, somebody makes profit in the same scheme, somebody makes loss in the same scheme. The scheme is same. Right? Somebody made a loss, somebody made a profit. How do you implement that is going to be a challenge in a platform where you have 500 rupee investors and 5 crore rupee investors investing at different points in time. But conceptually, there couldn't be something better than ally both client and the fund manager on the same side of the table.
Right, right. One more very interesting aspect. Digital disclosures instead of newspaper ads. The proposal replaces mandatory newspaper ads with digital disclosures on AMC website. Feroze, you've often spoken about informing communication, improving communication efficiency. Do you think this move genuinely helps investors, or it could reduce visibility for those who don't check AMC sites regularly?
Yes, Kavita, see, I think what is the country transitioning to? People transitioning to? The world is transitioning to AI, right? Today, what consumption of content happens also happens on social media. If AMCs are not going to be digitally available, circulars are not available. I think if I'm buying a scheme, the least I should do as an investor is to at least have in my favorites the asset management company's website. And I'm sure people learn that. And I think retail is not as no-wise as we think. Or in the last 10 years, there's so much investor education which is behind us, right? This year, we must ideally spend 1,500 crores on investor education, right? That's 2 bips, 0.02% of the total AUM. So I'm not too worried if it moves from the conventional newspapers because everybody is not buying all the newspapers. and it's not on the front sheet. Today, newspapers have more jackets than news. So I'm very happy that it goes to the website.
Yeah, totally. And the new investor base has a lot of young investors, so that's really helpful and a step in the right direction. But also simplification and removal of duplicates. Now, Feroze, Sebi has removed the half-yearly portfolio disclosure requirement, saying it duplicates other disclosures. Do you think this rationalization is long overdue, or it could lead to lower transparency for retail investors?
No, I think, see, Sebi takes all these actions with a lot of microscopic lens. That's what I get a sense.
Yeah, yeah.
So I don't see it as a worry at all.
Okay.
Disclosures, I think disclosure norms in the mutual fund industry are so stringent, and they are also wanting to make sure that there is ease of doing disclosures, right? You're not wanting to make it very difficult for a fund manager. For asset management companies have also lost a lot of talent because of the kind of over governance sometimes, right? You have some big fund managers. Prashant Jain went into managing AIFs, right? Sunil Singhania Saab went to start Abacus, which of course now they bring back mutual funds. So I personally think that SEBI does optimal governance is the aspiration. So I'm not too worried about the change.
One more very interesting aspect of this consultation paper, Feroze, advisory and Chinese wall provision. Another notable point, okay? AMCs can now offer advisory to non-broad-based funds under strict Chinese wall conditions. Now, from a governance standpoint, Feroze, how tricky is this to implement without conflict of interest?
Kavita, see, today already you have direct scheme. So there are quite a few asset management companies who have relationship managers on their roles, right? So they're not optically visible, but there are relationship managers on most of the asset management companies, top five. They're managing clients directly. So if you're managing clients directly and there's a cost involved to send a great resource, charging for that cost, make sure that the service is good and is lasting, right? Nobody is into social service, right? So if I'm going to send a very good relationship manager from the asset management company and he does not want a distributor, the client should be able to pay the asset management companies directly. So I'm very excited about it. Of course, as a distributor, I can see it as a competitor, but I would not see it as a competitor. The universe is the opportunity is so enormous that we need distributors.
Right,
If asset
right.
management companies can become advisors, I think it just
Absolutely.
expands the pie.
Totally, totally. So overall, Feroze, this definitely from an investor's point of view looks like a big positive. But any one caution that you would want to highlight from the investor's point of view?
See, I would want to highlight that always remember, if you're excited for cost, then you will surely miss out value. That's one point. Why do I say that? In the last 25 years, the best scheme in the diversified category and the worst scheme again in diversified category, the difference is 30%, 28% per annum difference. So 5-10 पैसे से कुछ नहीं होने वाला. Don't miss the woods for the trees. That's point one. Point two, there are some rights which the investors should have, and today it is not being delivered. I think this consultation paper speaks of one thing, that you can transfer your physical units as gifts, which I think is very, very important. If I can transfer my DMAT mutual fund units, why can't I transfer my physical units as a gift? That's point two. Point three, one thing which I think SEBI should look at, and I'm sure there's a lot of financial implications why this is not done. I can change my address on a OTP, I can get all my transactions on an OTP, but I can't change my broker on an OTP. If I don't have worker portability like you have in mobile industry, number portability, mobile COB, change of broker, should be available digitally. That's the only thing which requires physical forms to deter people to change a distributor. If I'm not doing a good job, I should have always the fear that the client can change me and sack me. That, I think, is your right as an investor. I think as a media house, you should present this, that if I can do all the transactions using OTP, why only broking? Change of broker is not on OTP basis. Feroze should be on the anvil to be sacked if I don't do a good job.
Interesting. Feroze, insightful as always. Thank you so much for decoding that so clearly for our viewers today. Thank you so much. And of course, we'll track the feedback process till 17th November closely. Thank you so much.